So let's start with those Fed minutes that everybody was waiting for eagerly, and they came out. The markets didn't know quite what to do with them. What did you make out of those minutes?
They confirmed what I suspected, which was that the Fed doesn't know where it is, that the world is very ambiguous at this point, and minutes of a meeting are a very poor way to convey a collective message. Look, the Fed has a fundamental problem about which it is not yet willing to be realistic, and that is that it is exceedingly unlikely that inflation can be brought down to target levels without a substantial increase in unemployment. They want to be very concerned about unemployment and about inflation. And the reality is that it's probably not so realistic to think that they're going to get inflation all the way down without getting unemployment up. And they don't want to acknowledge that, and that forces a certain confusion into all of their statements. I can sympathize and understand why they don't want to acknowledge that. Part of the problem is they've taken on an excessive obligation to communicate. So I think they're in a very, very difficult situation. I don't know to what extent they're going to choose to take the pain that is ahead on the stag side, and to what extent they're going to choose to take it on the inflation side. That remains to be seen. I suspect in some ultimate sense, they don't really know either which way it's going to go. It's got to worry them that financial conditions are now materially looser than they were when the Fed last met. And when in the middle of a tightening cycle, financial conditions are substantially loosening, that has to make a central bank nervous. David, there's one other aspect of this situation that I think is very important and under-recognized. And that is because everybody focuses, and focuses rightly, on the geopolitics, what's happening with Russia and Ukraine, what's happening with droughts, all of it. They don't really fully internalize that oil prices and wheat prices have both come down substantially and are predicted to come down substantially in the future. That's what's driving the relatively limited inflation expectations. And those who were quick to focus on concepts of core inflation when headline inflation was higher than core inflation can't stop doing that when headline inflation is lower than core inflation. And I don't see that we're really making any great progress with respect to core inflation. I don't see it with respect to the wage numbers. I don't see it with respect to the median or trimmed mean measures. And so I think we've still got a substantial inflation challenge ahead of us.
One of the things the Fed emphasized in the minutes, besides really being concerned about inflation expectations, on the other side of that was a softening housing market, something you referred to last week on this program. Give us your take of the housing market. Some people say we're in a housing recession right now.
So I think you have to distinguish movers from stayers, or to put it differently, you have to think about what the right way to look at rents is. Here's what's true. What's true is that last year, people who were signing new leases or buying new homes were paying 15 or 20% more than they had a year ago. Nothing like that fed into the consumer price index or the Fed's preferred measure, the PCE index. All that fed through was the small fraction of people who saw their rents change and a constant rent for everybody else. What that means is that down the road, like now, you're seeing inflation not because new leases are going up so fast, although they still are going up at a reasonable rate, but just because the people whose leases are coming up are seeing substantial increases. And so we're going to see significant housing price inflation in the measures of inflation that are used probably for another 6 to 9 months. That's a different thing than what builders are responding to. Builders aren't responding to that. Builders are responding to what they think the price of houses will be a year from now, and that come down. And so we're seeing a slowing in building, and that's what happens when interest rates go up. In some ways, it makes sense. If we're going to have a decline in economic activity, it's better to have a decline in something where we've already got a huge stock of it, and it's only the new flow that's being affected, than in something that we need to consume on a continuous basis and that doesn't have any duration to it. But I do think we're looking towards softness in the future with respect to housing, and I'm sure there'll be differential impacts in different parts of the country. As I say, my best guess is that we will have a meaningful recession sometime in the next 2 years. And if so, I think there's considerably more pain with respect to housing ahead.
Larry, when you talk about softness and slowing, we certainly saw that in numbers coming out of China at the beginning of this week. And I wonder what you make of the Chinese problems, as we know there are 3 or 4 of them that are interlocked there. But on the other hand, is it possible that will give at least a little relief to the Fed here on slowing inflation?
I think it probably will. It goes back to the issue we discussed a few minutes ago, David, about oil prices and grain prices. The main impact of Chinese slowing is likely to be on commodity prices. And there's a question as to how much weight those should be given as we think about our inflation rate in this country. But it probably is a positive on inflation. I think the larger questions involve how we see China in the future and how China will be responding to these economic difficulties. These, as I've been saying now for some time, are looking like increasingly profound events in China. It was taken as almost axiomatic 6 months or a year ago that at some point the Chinese economy would surpass the American economy in terms of total GDP at market exchange rates. That's now much less clear than it previously was. And I think you're seeing all kinds of challenges for China. There's the huge financial overhang. There's where the growth is going to come from. There's the growing Communist Party involvement in a wider range of enterprises. There's the demographic challenge. I have been saying for some time that I think people are going to look back at some of the economic forecasts about China in 2020 in the same way they looked back at economic forecasts for Russia that were made in 1960 or for Japan that were made in 1990.
Larry, one last one here. Toward the end of the week, Turkey's central bank made a move to try to combat inflation by, you won't believe this, cutting the interest rate from 14 to 13%. This, of course, is part of President Erdogan's theory of interest rates and inflation. What did you make of that?
President Erdogan is the world's first practical modern monetary theorist. He is putting modern monetary theory into effect. So far, it hasn't worked very well for him or for the Turkish people. I don't think that's going to turn around. And I hope that the misguided acolytes of modern monetary theory in the United States are watching.